My name is Jake, welcome to the channel. In today's video, we're gonna do a review my pie video where I review subscriber portfolios. This is the 56th video in this series. I've been doing this for about 4 years now, and I really enjoy it. I think I've kept the format the same, where I review portfolios and share my thoughts and ideas on how people are viewing the topic of dividend investing, and most particularly, how someone could live or reach the goal of living off of a dividend portfolio like my wife and I did here last year at the age of 37. The reason why I love this series so much is I see it more as a conversation. I see it as if you and I were sitting down in the same room having a conversation about your portfolio. This is more or less what I would tell you. And it's not a scripted video or anything like that. It's more of just you and I sitting down and having a conversation. So what you're seeing on your screen is the Panamanian flag. And when you're watching this video, I will just be getting back this week here from a trip from Panama. My dad and I went down to visit Panama because we're considering spending a couple of months a year, especially in the winter months, down in Panama. Because in Panama, they have their dry season more so in January to May. We're thinking about escaping the winter from Utah in January, February, March, and we're considering looking at other areas that we could maybe take a look at that are mostly affordable, right? Like I'd love to go to Hawaii, but I'm not a multimillionaire, unfortunately. But Panama, I've done a lot of research. It's a very safe, clean country, very welcoming to expats. And we went down and we visited Boquete, an area where I'll probably talk more about in future videos. But that's where we're going down, is in Boquete, a little bit in Coronado Beach, David, if you're familiar with the area. Yeah, if you're considering looking at areas or countries abroad to maybe either escape in the winter or even semi or fully retire, Panama is definitely an interesting choice. So in today's Review My Pie, we're going to review 4 subscriber portfolios. Usually I answer a subscriber question, but there was a portfolio that just got recently sent in, and I thought it was really interesting because I've been talking a lot about this topic, and I want to show how somebody implemented this in practice. So we're going to review 4 portfolios. The first is from a 27-year-old here from the US. They're all from the US. The second, a 32-year-old. The third, a 42-year-old. And then the fourth, a 56-year-old. And as always, everybody, the timestamps will be in the description, as well as the portfolio links will be in the description. And as always, everybody, I'm not a financial advisor. Please don't take this as professional financial advice. It's just merely for your entertainment. And as always, everybody, I don't script what I'm going to say in these videos. I'm reviewing the portfolios as I'm recording the video. So I don't know what to expect. So it could be good, bad, ugly. I have no idea. So the format's pretty much the same. Everybody knows the rules.
One bite, everybody knows the rules.
So in a lot of these Review My Pies, I've noticed that a lot of people try to mimic indices or build their own index fund with individual stocks. And that's not always a bad idea. When you build your own index fund with individual stocks, sometimes it works and sometimes it doesn't. And if it doesn't work, it could look a little like this.
Saucy's pretty good. Saucy's pretty good. Holy!
Oh my gosh. Oh man, I love it. I love it. All right, cool. So let's take a look at the first portfolio. I wanted to include this one because I thought it was interesting. If you're a subscriber of the channel, you've heard me talk a lot about the simple path to wealth with dividend investing using the core and satellite approach to investing. Now, this was inspired by J.L. Collins, and I've been harping on this for the last year or so. And I really am a huge fan of this type of investing because, like many of you know, I retired recently here off of my dividend portfolio, but I made a lot of mistakes along the way. And I wish I would have stumbled across this approach 5, 10 years ago. It would have made my life so much easier, so many less sleepless nights stressing about my portfolio. And the reason why I included this is because I saw just here recently this email from Miguel, and he implemented the simple path to wealth with dividend investing using the core and satellite. And I want to show you how someone interpreted that video or this concept that I've been talking a lot about So let's take a look at what he has to say here. So Miguel writes, I'm 27 years old and I'm currently investing $1,000 a month to my dividend growth portfolio. I love to retire early within the next 25 years with this portfolio. My biggest holding is SHD with 50%, followed by DGRO with 25%, which makes up the core of my overall portfolio. Additionally, none of the individual stocks make up more than 3% of my overall portfolio. Any feedback is appreciated to hear and hope to hear from you soon. Thank you, Miguel. So once again, I'm sharing this with you intentionally because I think this is so incredible that Miguel, a 27-year-old, is taking what I'm saying from my videos and implementing it. Whether that's right and whether Miguel stays with this long-term or not, that's time will only tell, but at least he has this foundation and he'll hopefully be able to build upon this, because the reason why this is so powerful is this is the blueprint. This is the foundation that you need. The investing, like one of the things that a lot of us struggle with, myself included, is when we first start out, we think that we have to over-engineer things and we're only going to get to retirement by picking the right stocks. That's an illusion, guys. It doesn't work that way, okay? For the majority of us, if you truly want to build wealth in America, whether you were born here or not, the way that you build wealth in America is you have the foundation and you focus on the basics. You stay out of consumer debt. You spend less than you make and you look to make more money and try to invest a little bit more every single year. And keep, like, that's really what it comes down to, okay? And so, Miguel, if you're trying to retire within 25 years, your life is going to change dramatically over these next 25 years. You may have kids, you may buy a house, there's many different things that could come up, but investing should not be a stressful thing. And using this approach, I believe it simplifies things, and I believe it sets your average person up for success. All right, let's take a look at your portfolio here in M1 Finance. It looks like you have 12 holdings. You have a good dividend yield for a 25-year time horizon. This is not bad. You could even have a little bit of a lower dividend yield. Okay, so this is fine. An expense ratio that's very low. I love to see this. You got 25% in your satellite positions and you got 75% in your core. What I usually like to say is for the most people, 70 to 80% of your portfolio should be in your core portfolio, okay? And if you're hearing this for the very first time, at the end of the video, I will have a video pop up and where I talk about the core and satellite and I talk about the simple path to wealth. So if you're not familiar with what I'm saying, this is really important, guys, especially if you're following my channel and if you get value out of what I'm saying. That will make more sense in that video, but you can watch that video next. So you're focused here on a core and satellite approach. You're focusing on not having more than one individual stock represent more than 5% of your overall portfolio. So that's what I talk a lot about here. So let's look at what's in your core. In your core, you said that you had 50% into SHD and 25 into DGRO. I think that's fine. I think, SHD is kind of a unicorn where you're getting really great growth, dividend growth, and you have a high dividend. 2023 was a little bit difficult for SHD. It only grew, the dividend growth rate in 2023 was like 3 or 4%, whereas with DGRO, it was over 10%. So, the market works in cycles. Generally, you would expect more dividend growth going forward with DGRO, but, that's just kind of, it's difficult to say because these ETFs have not been around for decades. So it's hard to really say. But my gut tells me that you're probably going forward, you're probably going to get more growth with DGRO just simply by how the index is set up. So what you could consider doing is you could even consider setting these up 50-50 in this slice instead of trying to go so heavy into SHD. That's just an idea, something to consider, but that's something that I would definitely take a look at, because the 2%, 2.7% dividend yield right now, I don't think you necessarily need that right now. What you could always do is in 5 years, you could always adjust that later to get that higher yield or higher allocation to SHD. But that's just my opinion. Next, let's take a look at your satellite positions. Satellite positions, very, very straightforward, 10 holdings, all individual companies, a very good dividend yield for your time horizon, all well-known blue chip companies. You got, your different industries in here with retail. I think a lot of retail which is fine. You probably bank at JP Morgan. You probably eat Lay's chips. You probably have a PC or an iPhone. Probably shop at Costco or Target or Lowe's. Like, I really like that you're focused more on consumer brands, because these generally people can understand more. And when there's a recession and the market drops by 50%, you're more inclined to stay in these stocks versus emotionally sell out of them when the market goes down. So kudos to you. I like this. I think this is an easy portfolio. Once again, I just wanted to share this with you because this is how someone interpreted what I said with the simple path to wealth with dividend investing using the Corn satellite. This is how it could look. Whether this is the right approach for you watching this video, that's to be determined. But this is a simple way of how you can kind of adopt what I'm saying and gain inspiration from what I'm saying and really create your own way, your own path when it comes to this. So I hope that this was helpful. I hope this kind of showed you in practice how you could implement what I'm talking about with the simple path to wealth with dividend investing. Miguel, thank you so much for sending over your portfolio. All right, let's take a look at the next portfolio from Shri. He writes, "Hi Jake, hope you're well. I hope you can review my portfolio. My wife and I are 32. I'm hoping we can invest at least $3,000 per month. Please let me know what you think." So let's take a look at some of your details here. You write here that we have the opportunity to cash out some company RSUs. These are restricted stock units. A lot of companies will issue these, for bonuses or hiring, incentives, stuff like that. So you get stock in the company. We have a combined of 300,000 in their 401k. We're purchasing a new condo this year, so new. So I'm assuming, do you have an old one or just your first one? I'm not sure what you mean by that. Hoping that we can still do the $3,000 after the purchase. My company offers a mega backdoor in a 401k, so I can invest further using my after-tax 401k to reach the 60k in 401k per year. No employer match after the initial 22,500. So if you're doing the backdoor Roth IRA, that means you make over a combined 200,000 a year, which is great to hear. So you can do the backdoor Roth IRA. That's great. Any other forms of investment recommendations? What do you have down here? Really love your channel, watching your videos, a productive time spent on YouTube. Keep doing and spreading the loss. Well, hey, Shri, thank you so much, man. I appreciate you saying this. You're in a really, really good spot. So you have I guess you could say first world problems where you're trying to decide what to do with all this wonderful money that you have. This is great. So a couple of things. What I would recommend that you do is, on my channel, I like trying to help people to think differently. You are someone who is very different than the norm. The norm in America is you're in debt up to your nose, and that you have student loan debt, you have car payments, like debt. If you can stay out of debt, if you can continue to invest, except for your condo, if you want to have a mortgage, I think that's different. I'm actually pro-mortgage, assuming that the rate is favorable. If you can think about this differently and ask the question, well, what are your goals? Most people in America and across the globe don't have the choice but to work until they're 65. They don't have the choice. You, my friend, you and your wife may have the choice to be different and choose a different lifestyle because you're different. You probably went to school for a very long time. You probably have a skill set that is very valuable, hence why you're making so much money. So you may be able to use this to your advantage and think outside of the box. And when you think outside of the box, you may kind of think, oh, I might be doing this wrong because I'm thinking differently. It's okay to be different. It's okay to not just invest into your tax advantage accounts like a Roth IRA or 401k. It's okay to also invest into an individual account if your goal is to retire earlier. If you're planning on retiring at the age of 59 and a half and keep working until then, keep maxing out your 401k, max out your Roth IRA, max out your HSA, and be a multimillionaire when you're 60. That's cool. You can do that, right? If you want to be different and you want to retire early and you want to buy your freedom, well, at this point, I think, after you've already invested $300,000 in your 401k and you're only 32, you can not invest another dollar in your 401k and you'll have about $2 million at retirement. Did you hear that? Have you done the math on that? Have you used reinvestment calculator to see how the compounding works with that? That's really incredible. If you didn't invest a single dollar from now until you're 59 and a half, you'd have about with expected returns of about 7 to 9% in the stock market yearly over that period of time, you could reasonably assume about $2 million, give or take. So you could coast fire and not invest a single dime into your retirement accounts, and now heavily focus for the next 10 years on investing into your taxable account so that you can retire at the age of 40, while your 401k is compounding in the background. And if you didn't watch my video from a couple of weeks ago, that's exactly what my wife and I did. In the first part of our career, we heavily invested into our 401ks and Roth IRAs. And then the last few years, we stopped doing that and just invested into our taxable account so that while, in the background, our retirement accounts are just coasting. So that's something that I would definitely consider. That's one option. The other option is the Roth IRA conversion ladder. That may be something that is right up your alley. It takes a lot of planning, but if you're hearing this for the first time, Google Roth IRA conversion ladder, and I think that may help you. So that's some initial thought. Like, this is really difficult to kind of give you, other, opinions on your situation, because this is only limited to what you've given me. But it sounds like you're different. You're a high net earner. Maybe you can live a different lifestyle than your parents and your friends, and that may be possible. So something to consider. All right, Shri, let's take a look at your portfolio. Your portfolio is up just a ton. This is incredible. So what do you got? You got 13 holdings, a very low dividend yield. This is good, especially, I don't believe you told me if this is in a taxable or in a Roth. I'm going to assume that this is in a taxable account. And if it is in a Roth account, it's fine. Like this, there's no one strategy that can work with this. But if this isn't a taxable account, especially if you're a high net earner, this is very important that you maintain, tax efficiency. You do have a reasonable expense ratio. What do you have in here? So you got 13 holdings, you got VOO at the highest, VGT, you got the SMH, really, really great growth ETFs. Like these two right here, really, really great. This is focused on semiconductors. This has gone up, I think, like 20% a year over the last 10 years. Absolutely incredible. Small cap value. Okay, great. Healthcare, Berkshire Hathaway, consumer discretionary. What is this INDA? What is this? It tracks of India. Oh, Indian. Okay, so this is focused on international, on companies in India. Growth Story and Jets. Okay, let's see what you got here in growth stories. Okay, yeah, top largest companies in America. Okay, great. So this is very, very tech and growth centric. So I like that, especially if you're a high earner and you're in a high tax bracket. You want to focus on tax efficiency much more than maybe somebody else who's in a very low tax bracket. Tax efficiency is probably one of the most important things. Once you start considering a backdoor Roth IRA, you really got to double down on your understanding of how to optimize for taxes. Like that plays such an important role. It's first world problems, but it's something that really, really comes with making a lot of money. You got to make sure that you're optimizing it so you're retaining as much money that you're making as possible. Okay, so I think there's a lot of options here. Like this is a great approach. I guess the thing that I would share with you is, and I've talked a lot about this on my channel, is ask the question why. Why are you investing into these individual holdings, and what is the purpose? Are you investing into these to sell them in 10 years and 20 years and then rebalance into something else? Or are you just selling them so that you can live off the dividend? If you're trying to live off of the dividend from this portfolio, I'm sorry, man, it's going to be very, very difficult and it's going to take decades to do that unless you're a multi-millionaire and you have low expenses. For the majority of people out there, that's not going to be feasible to retire off of dividends, from just dividends alone from growth ETFs. So ask the question, what is your purpose behind why you invest into each one of these? And if you don't have an answer, reevaluate your strategy. And that's really what it comes down to. Especially when you're 32 years old, you probably don't have everything figured out, but try to understand why you're doing it. Why are you investing in this ETF? What is the purpose behind it? And that will help guide you to make the right decisions that will help you meet your individual goals. And that's the beautiful thing about this. Your goals may be completely different from somebody else. Okay, so understand your goals, understand your why, and enjoy the journey. So, Shri, thank you so much for sending over your portfolio. Best of luck to you and your wife. All right, let's take a look at the next portfolio from Steven. He writes, sorry if I'm not doing this right, but I'm a new subscriber. No worries, man. I'm 42 years old from the United States. I just started investing less than a year ago. I currently have $15,000 invested in 20 different ETFs and companies. Once every 2 weeks, I split $500 into the following companies. We'll take a look at these here in just a second. I'm hoping to create supplemental passive income over time that can be used to help with my monthly living expenses. For now, I'm reinvesting all dividends and pushing for as much growth as possible. I really appreciate your content. Any thoughts or advice would be very helpful. Thanks. Well, Stephen, thank you so much for the email. Thank you so much for sending this over. I think, you're only thinking about a small percentage of this equation of retiring or living off of your dividend portfolio or generating supplemental income. The investments that you invest in, these are just vehicles, right? Like this is nothing more than just helping you get to your goal. And it sounds like you have your goal. Your goal is very straightforward. Here in the coming years, I guess you want to supplement maybe your W-2 income or your regular job income with passive income. I think it's a great idea. I think it's a great strategy. Let's take a look at what you have in here. So you have it split up between ETFs and individual stocks. You got VOO, this is the S&P 500. You got VTI. Okay, right off the bat, I shared this a little bit in the last one. It's going to be very, very difficult to live off of the dividend income from these ETFs. So I would argue that you may want to reconsider this part, because for me, this is not buy and hold if you want to live off the dividend. This is buy and rebalance in the future. Do you understand that? So with these other ones, you can hold them like SHD. SHD is buy and hold forever. It has a great dividend. It has great dividend growth. It has a great yield on cost if you hold it for many years and decades. With VOO and VTI, the dividend is too low. Okay, and so it's going to take a lot of money to live off of the dividend. So I would maybe kind of rethink or consider maybe looking at this from a buy now, hold, and rebalance later. Okay, so that's something that a lot of new dividend investors don't really understand, that VTI and VOO, they're great ETFs, but they're not designed, they're not for dividend investing. Like they're not really ideal for dividend investors unless you have a lot of money and a very, very long-term time horizon. Do you understand? Okay, cool. We're on the same page. So SHD, buy and hold forever. Microsoft kind of fits in with these ones, but I could see a case for holding Microsoft forever. Apple, it's a little bit difficult. You're going to need a long time to be able to live off the dividend from Apple. And so you got Visa. Visa's kind of in the same thing, but you said you wanted growth. Okay, well, you're definitely going to get growth, but it's going to take a very, very long time to be able to truly enjoy the dividend from Visa, Apple, and Microsoft. And Disney, yeah, okay, Starbucks kind of fits in there. So I like this. I like the companies in here. Waste Management, McCormick. McCormick's a great company, really, really low dividend. A.O. Smith is kind of a good balance. Abbott, 3M, Home Depot, VFC. A few of these are, this one's a little bit questionable with the dividend, this one. So I guess what I would say is I would reevaluate your strategy here. And what I would do is when you're looking at a portfolio like this, is I would look at each individual stock, an ETF, and I would ask the question, okay, is this a buy and hold forever? And am I going to live off the dividend? And how long is it going to take me to be able to live off of the dividend? I've talked a lot about, dividend reinvestment calculators on my channel. Go check them out. I'll have a card pop up here in the top right to a video about a dividend reinvestment calculator that may help you. But what I would recommend is, like I said, review every single individual company and ETF and ask the question, or even write it down. Like I would print this out, write down next to it. Is this a buy and hold forever? Or is this buy, hold, and rebalance later? Okay, because that will help you to visualize and understand what you're investing in, why you're investing in it, and how it's going to get you to your goal. Okay, does that make sense? Just picking stocks at random because they're good stocks or a YouTuber invests in them and says they're good doesn't mean that it's going to fit your unique goal and strategy. Okay. So Stephen, I hope that that helps. There's a lot more things that you want to consider, like taxes, time horizon, all of those different things that you want to consider. And I hope that you've been watching some of my videos here on my channel. What I don't want you to think is by picking the right stocks is going to get you there. That's only a fraction of the equation here. So you're going to need to consider, the big picture as well, cutting your expenses, staying out of consumer debt, and looking for how can you go from investing $500 to maybe $600 every 2 weeks. Those are the type of things that you want to think about. Stephen, I know that that's some pretty basic stuff, but I hope that it's helpful and I hope it gives you focus in your goal to supplementing your income with dividend investing. Thanks for sending over your portfolio. All right, the last portfolio is going to be from Dewey. He writes, "Hi Jake, I've come across your YouTube series and it's a great resource." Hey, thanks for saying that. I've been an investor for close to 20 years and I'm 56 years old. I only started to test out dividend investing in the past 2 years. I put a few of my accounts in some dividends to see if it would really provide the income and growth as expected. I've subscribed to many different groups to educate myself that talk about how to select dividends and to have tried to apply many of these approaches with my time horizon and risk tolerance. For example, the safe dividends, big safe dividends, the Oxford lever, Dividend Hunter. Okay, cool. So I have taken some of my Roth and TD Ameritrade accounts and linked them to trackyourdividends.com. See attached. So this is the screenshot that we're going to take a look at here in a second. I realize this is an M1, but I hope, M1, you don't have to just send M1. You can send any brokerage. I'll take a look at it. I also use Seeking Alpha for analysis. I've landed on using Dividend Hunter as a source to select my dividend stocks. Okay. These accounts make up $520K, which is now generating annual income of $32,000. That's really good. That's really good. This seems to be working with very little adjustments. I plan on retiring in 4 years at the age of 59 and a half, and I have a 401k that is another 1.5 million that will be 2.2 million in 4 years based on my contributions and forecasts. I started this portfolio attached to see if the dividend investing works before I direct my entire 401k towards the strategy. You cover a lot of building your portfolio to increase your balance, but I've built up my nest egg and I'm focused more on how to optimize the yield to generate $160,000 of dividend income. Could you look at my portfolio and provide your feedback? Your recommendations tend to be more conservative with lower initial yields because you're looking at a total return growth and annual yields, which is great to build the portfolio. I'm focusing on annual income generation now. Please ignore some of the growth ETFs like ARK. And as I plan to sell these in the next business cycle, it included some of these in the linked accounts that you said. Okay, so you're absolutely right. So Dewey, I generally talk more to 20-year-olds, 30-year-olds, those of you who have maybe a 10, 20, maybe a 30-year time horizon, but there are definitely those of you out there who have maybe a 5-year time horizon, or in your case, a 4-year time horizon. And a 4-year investing time horizon is fundamentally different than somebody who has a 20-year time horizon. Everything from taxes to optimizing your accounts, everything that comes with that. With you, it's very, very straightforward. You're maxing out your tax advantage accounts. That's the first thing. You want to maximize your tax advantage accounts. If you have a Roth IRA with like $2.2 million, if you were to convert the 401k to a Roth as an example, or if you already have the Roth, you're getting tax-free income. So for example, if you want income, you could explore at other options like these conservative cover call ETFs like JEPI and JEPQ as an example. That's something that you could definitely take a look at. Whereas, somebody who's in their 20s, they should avoid that like the plague when they have like a 10 or a 20-year time horizon. It doesn't fit their time horizon, but it does fit yours. And so with this, we're looking at wealth preservation instead of wealth accumulation, because you've already accumulated your net worth, your money. Now it's about how do you get it to work in your favor and work for you. All right, so let's take a look at your portfolio here. This is in your IRA. This is, okay, let's see here. You got a yield on cost of 6.75%. I really, really like that. You said that, you wanted 160,000. Let's do some napkin math here. So you said you wanted 160,000 divided by 2.2 million. That means you need about 7.3% dividend yield. Now, what you could do is you could have maybe a 7 or a 6 or a 6.5% dividend yield while still focusing on investments that are growing. Or you could go straight for the 7.5% yield, but sacrifice a little bit on the growth. So what I would recommend is I would kind of see what's most valuable to you. I would definitely look for investments to have a portfolio that's growing its dividend by at least 5% a year. You want to make sure that you're outpacing inflation. I think at least 5% should be something that everyone should target, even if you're looking to live off of the income today. You don't want to have your incomes not outpace inflation and have a negative real return over the remaining lifespan of your retirement. Okay, so that's what you're looking at. You're looking at about a 7% dividend yield. You're not very far off. All right, so let's take a look and see what you got in here. You got a mutual fund, I believe, in Dodge and Cox. You got ARCC. Okay, that's not bad. You got Pepsi. I'm probably not going to recognize every one of these. Hercules Capital, I'm not really heard of them. Arbor Realty, okay. Not heard of this one, a preferred one. You got JEPQ. This is a really good one. I own this one. This is a cover call ETF. RYLD, this is fine. This is from Global X tracking the Russell 2000. JEPI, and I was just talking about these cover call ETFs, and you're all in on these. Okay, cool. You got a few others. Okay, International Business Machine, DSL. Okay, interesting. You got a good amount of energy. You got semiconductor with TSM. So you got even Costco in here, EPR, Nvidia, Main Street, FDRXX, and then the ARC funds that you mentioned earlier. All right, so Dewey, I think, from a glance here, I think this is a little bit too complicated. I think you have a little bit too much in here. Now, I want to give you a scenario that is not something that we as human beings like to think about, but I want to give you something to really think about. You're going to be retiring here in 4 years. What happens if something unfortunate happens to you that we can't expect, foresee in life? Let's say you were to pass away. Is your wife going to be able, or your spouse going to be able to take this over and to manage this? Are you hurting your significant other by having a portfolio like this? Is this too complicated? Have you talked about this with your spouse? And if you haven't, that's something that you probably want to consider doing. Because if something were to happen, obviously we never like planning for this, but that's the reality. It seems like this is really, really complicated. Unless your spouse has reviewed this with you and understands this, I think you may want to reconsider on how you can make this a little bit simpler and easier and more straightforward. So that's my initial thought when it comes to this. As I get older, I think about those things a little bit more. It's not the most exciting thing to think about, obviously. When you're in your 20s and 30s, you don't think about that. But I would encourage you to think about that. And so think about how you can maybe simplify this, and maybe you have a spreadsheet that you use that you plan with, but at a glance here, I don't like this. I think this is a little bit too complicated. I would cut this in half or in a third and focus on a way where you focus on what really you want to invest in and that you could see yourself holding. And unless you're somebody who likes to, enjoys this to buy in and buy out. But I think for most people, when you're 56 years old, do you really want to be stressing about this? Or 59 when you plan on retiring? I would encourage you to try to get this to, a half or a third and really focus on quality and investments that you understand and where you could see yourself holding and passing on either to your spouse or to your family should something happen. So that's something to definitely consider. Okay, so now let's go to the next one that you sent here. This is your annual income and portfolio value, and it's a projection. Okay, this is pretty cool. So you can see that the dividend income is still continuing to grow. Okay, I think that's great. Okay, so you're investing into ETFs and stocks that are projected to still continue to grow. That's great. That's very, very important. I think I guess my final thoughts when it comes to this, when I see this, Dewey, I kind of get a little bit, oh man, I get a little nervous when I see this kind of stuff. I would try to simplify things a little bit more, focus on, ETFs that have a lower expense ratio, reconsider some of these mutual funds, and simplify. If your spouse can't understand it, it's too complicated. The main things that you want to focus on, a couple of things. You want to focus on a balance between the current yield and the dividend growth rate. That's incredibly important. So you're getting around a 6.5%, 7% starting forward dividend yield, and you're going to accomplish that with a lot of these higher yielding cover call ETFs, which I think is what you're doing, like JEPI, JEPQ, RYLD. Those ones are good. That's a really, really good approach. And you couple that with maybe a high quality dividend growth ETF like SCHD and DGRO. And what you're doing, and balance it out with your individual stocks like your IBMs, your Home Depots, etc. So whatever you want. But by doing that and looking at this holistically, you're going to have a balanced approach where you're going to have high yielders and high growers, and you're combining them together to get you to your 7% starting forward yield plus around a 5% dividend growth rate. And if you can do that, I think that's the way to go about it. And in your email, you were a little bit hesitant to go all in on this dividend thing. I think if you simplify things a lot more and have a straightforward strategy, I think you'll have more confidence in your approach here. So simplify it, review it with your spouse, understand what you're trying to accomplish here, and really, at the end of the day, it's just math. How can you balance it out so that, what's difficult is you're dealing with future projections that are not guaranteed, so it can be a little funky, but just go off of historical data and allow for a little bit of a margin of error where it may, in some years be less and higher. So you're kind of factoring in more of a conservative growth rate and a conservative dividend yield when projecting future returns. But all in all, that's really what comes to mind when I see a portfolio like this. The really, really important thing is that you're taking advantage of your tax advantaged accounts, which it sounds like you are. That's what I would say to this. It sounds like you're not fully convinced just yet. And I think it's because you're overcomplicating things. So try to trim this down a little bit and see how you can simplify it. I hope that helps. I hope that that's something that will help you zoom in on your focus and make it a little bit easier for you. Well, everyone, thank you so much for watching. I hope that the video was helpful. I hope that you learned something new, and I'll see everyone in next week's video.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.